What's up, Periscope? Ty Crandall here with Credit Suite, and today we are making a big zig because today we're going to be starting the process of jumping in and talking about credit scoring. We're going to be talking about three types of credit you have. I'm going to teach you real quick the three types of credit that you have as a business owner. Then we're going to decode consumer credit. I'm going to teach you some things you never knew with consumer credit. What's up, Prince? Welcome, everybody. I appreciate you coming. Make sure if you like what's going on, you give us some love during this, and also make sure you share this with other people so they can enjoy the benefit. So we've talked a lot about business credit. We've talked a lot about business loans, but let's be honest. If you're going to build a business, you need to know about your credit because your credit's going to be used. Hey, coach, what's up? What do you think of credit consolidation? It depends. I'm interested in the knowledge. Great, we're going to share. It depends on what you're consolidating. And maybe what I'm going to go over with you might give you some information. And if you want to expand about that as we go, I'll gladly answer any specific questions that you have. But credit consolidation is great. If you're consolidating, you think you're talking about debt consolidation, and that's good. If you're consolidating debt, if you have questions specific about credit consolidation, let me know exactly what it is that you're referencing, and I'll give you some specific answers. So this is what you need to know. There's three types of credit you have. Okay, as you have your consumer credit, which you're obviously familiar with, right? This is something like your FICO score here, right? You've also got business credit. We've talked about business credit. We've talked extensively about how you build business credit. In our past scopes, we've mapped out these steps here to build business credit. We also have a third type of credit called bank credit. And bank credit is an internal credit scoring system only used by the bank. You'll never see your bank credit scores ever. You will never know what they are. You'll never see them, but I'm going to teach you to them in the weeks to come. Today, we're going to decode consumer credit. I'm going to teach you a lot of cool stuff relating to consumer credit. So you have three types of credit as a business owner. Consumer credit linked to your social security number, your FICO or your business credit that's linked to your business EIN, and the third type of credit is bank credit, which is how you are scored based on how you manage your business bank account. Thank you guys very much for the love. I appreciate it. Is it true that banks offer better rates and terms than alternative lenders? Not necessarily. And I'll give you a rundown. If you look at collateral, which is offered through alternative lenders, this kind of financing offers you interest rates from 1 to 5% if you have some kind of collateral. That crushes SBA rates. If you have good personal credit, you can get unsecured financing and private money, which is ultimately better than what you'll find at most banks. Cash flow financing is pretty expensive. This kind of financing you're not going to ever see cheaper than a bank. And that guy got 7.5%. He would never get that on a conventional bank SBA loan. So it depends on your risk, depends on the type. In a lot of cases, alternative lenders actually can be big banks. Hey, what's up? Hey. But in the cases they can't, it's because your risk is so high that a bank wouldn't be able to help you anyways. An alternative lender might work better. So if you can qualify for an SBA loan, those are great. They're probably going to give you some of the best terms that you're going to find. But alternative lenders, if you have collateral and other things like that, can also give you very competitive, even better terms. Hey, what's up, Chicago? Scotty is in the house. What's up, Scotty? Okay, so let's jump. Little guy right here. So this is basically how your consumer credit breaks down, and I'm going to give you a lot more details as we go. I'm going to grab orange here, Gators color, good. Payment history is 35% of your score. Utilization's 30% of your score. The time you had credit for, the length of credit's 15%. New credit's 10%. Your credit mix is 10%. So here's how your FICO score actually breaks down. Right here. There's 5 different components to it. We're going to break down and decode each one of these in depth. And the question comes in, does bank rating apply to consumer banking? No, it only applies to business banking. It's only how you are judged to get a business loan at a bank or to get a bank loan for a business. It has nothing to do with consumer credit. So the biggest factor of your credit is payment history, which is 35% of your score. This is the biggest factor of your credit score. And there's actually 3 components to your payment history. The recency, how recent you've had derogatory late payments, how frequently you're having late payments, and the severity of your late payments. Okay. So the FICO score, by definition, depicts your risk of going 90 days late on an account in the next 2 years. So think of it like this. If you have a history of going 90 days late, then obviously your risk of going 90 days late in the future is much greater than if you have a history of going only 30 days late. So the biggest factor in the FICO score is how you pay your bills. Do you pay them on time or do you not pay them on time? But it also has to do, if you have negatives, of how recent those negatives are. How often are you late and how severe are your late payments? A 90 days is much worse than a 30-day late, for example. The worst, obviously, are collections, judgments, bankruptcies, repossessions, and all of those have to do with 120 plus days late, considering a complete default. The worst thing you can have. Thank you guys very much for the love. It lets me know that the message that I'm kind of throwing out there makes sense. So you can do test drive a new compact truck now. All right, Christine, good job. Good for you. You deserve it with all the credit you've been getting on the business side. And this is Christine that just chimed in. Here's some of her business credit approvals. We've been following those as she goes. So second biggest factor, guys, this is one of the most important things you're going to need to know about your consumer credit score right here. Of everything I'm going to talk about today, it's probably the most important. 30% of your score is made up of what's called utilization. Basically, how much of the accounts that you have do you owe versus the balance, and what percentage is that? Somebody's asking, if I qualify for the credit from one of your alternative lenders, will I have access to cash? Yeah, absolutely. All of our lenders will give you cash, and as a matter of fact, in our finance suite, we just added at least 2 new cash credit cards. So even if you don't have a qualifying factor to qualify for a business loan, we now have even more cash access where you can get access to money for your business based on business credit as well. So guys, back to this. Utilization, a third of your score, nearly 30%. You can see how big of the pie it accounts for. How much do you owe in relation to how much you had borrowed on the loan, and what percentage do you owe? Here's what I want you to see. Look at that. 35% payment history, 30% utilization. Look at this. These two factors account for this much of your score pie, and then that affects the rest. Because you can control utilization. Utilization is nearly a third of your credit score, which means if you have low credit scores, which I find a lot of people have low scores for this one reason, it's because they don't have high limit credit accounts. If you have high limit credit accounts, then what can happen with high limit credit accounts is it will radically boost your scores. So for example, when I owned a credit repair company, what we would do is we would help people get a credit account called My Jewelry Club. And this would give them a $5,000 credit line. All they could do is buy jewelry at this one store. But the minute that account hit the credit report for $5,000 of available credit, the scores would skyrocket. We would see scores jump 50 to 100 points just because we added 5,000 in available credit. You can do the same thing. You can use that kind of account. You could get put on a credit account as an authorized user for a family member. You could put money down and get a secured credit card. The one big factor you can control of your credit score is utilization. By adding a lot of available credit, you really boost your scores. But I've seen it go the opposite way. When I owned a mortgage company, I've seen people get denied because they had a score high enough to qualify. They had a $500 limit credit card. They put a $300 balance on that credit card. And because the balance to limit ratio was so big or was so small, then what happened was their scores tanked and they could no longer get a mortgage. So what is the name again, Coach? That is the My Jewelers. I cannot say Jewelers. My Jewelers Club card is what you can look into to get that actual account. So, and I need to put a link on our website, and I will do that to help you on the next scope. I'll probably have it here. Something that you can use to use that kind of account. Great account for credit building. The bottom line is that you want to add a lot of available credit, and in doing so you really boost your score. You also need to know that if you overutilize your account, if you have credit cards and you have balances, especially over 30% of the limits, you will tank your credit scores. It's almost hurt you as much as paying the payment late because it's just math. 35% of your score's payment history, 30% utilization. So by owing more than you should, which is 30% or more of the limit of an account, you will tank your credit scores. You want to keep your balances on credit cards very small, preferably below 2% to maximize this aspect of the score. That helped me massively. It added 75 points. So you must have got that jewelry card. It's for real, right? 50 to 100 points, we would see it raise people's scores. How do you justify your lates when you were on workman comp for 4 years and now catching up? You don't. You challenge them. Guys, the Fair Credit Reporting Act gives you the ability to challenge anything and everything on your credit report. Okay, if you go to our YouTube channel, youtube.com/credit suite, and that's My Jewelers Club. Jewelers Club is what he's talking about. Again, I will have a link to that exact account on my next scope. I will have it right. I will have it on the whiteboard. Okay, I will get that done for you guys. So it's a really big deal. You want to add as much available credit as you can. Keep your utilization low or you'll really tank your scores. And that's one aspect of your score you can control the most. It's a big deal, so I would focus. The biggest aspect of your credit score is the length of time you've had credit for. It's 15% of your overall credit score. There you go, myjewelersclub.com. Although I cannot say Jewelers Club for some reason. So length of credit history, 15% of your score, and it has to do with the age of your oldest account, how long your oldest account is, and the average age of all of your accounts. So let's look at these closely. You need to have long-standing credit history. You need to have the average age of all of your accounts to be as long as possible. So an authorized user account from a family member can help here. If somebody adds you as an authorized user to their existing credit card that's got long-standing history, as long as the utilization is good on it, then it makes sense. That can really boost this aspect of your score. Okay, and it can boost this aspect because you're adding available credit all through an authorized user. All of your accounts affects your length of credit history. Length control. This is why I don't like consumer credit scoring. In business credit scoring world, you're primarily scored on how you pay your bills. You pay your bills, you get a good score. But length of credit history is very tough to control with FICO. So the biggest and best known hack to deal with this is called an authorized user account. I'll tell you exactly how it works. Fingerhut's a great card. Somebody's asking how's Fingerhut. Anybody that will give you credit with decent limits that you keep the balances low is a good card. Fingerhut's a great card for credit rebuilding. So here's what to keep in mind. Let's say that like my brother, my friend, somebody I have in my family that has low credit. I can add them to my credit report to a credit card that is an authorized user. They don't physically have the card, so they're not going to use it, but that account will report on their credit report. They get credit for the utilization, they get credit for the high limit, and if it's a long-standing account, I gave them a long-standing account, improving the length of credit history. So I just helped improve 45. Well, actually, if the payment history is good on that account, let's look at that. If you get added as hey, welcome, Oaken Can. This is your first time on Periscope. Welcome. How about no verified documents when requested and hasn't removed or stopped reporting? Well, then, okay, so then what you should do in that case, and what you're saying is you disputed it with the credit reporting credit bureau. They didn't send you any documentation. There's a lot of ways you could fix credit, guys. And I will jump into that, a little bit of that right now. First of all, the Fair Credit Reporting Act says you have the right to challenge anything and everything on your credit report, and I suggest you challenge the heck out of it every 30 days until an item comes off. Challenge the account number, challenge the account name, challenge the status, challenge the payments that say you're late, challenge it all. Because you're entitled to challenge it all, and if it's not 100% accurate, verifiable, it should be removed. Let's say to put a dispute to the credit bureaus, they verify it, you know it's untrue. Then go to the creditor, certified mail, and challenge them and ask for documentation verifying it's untrue. If they don't respond or don't remove the account, file a BBB complaint. File a Consumer Financial Protection Bureau account. You know what that'll do? Get it removed really freaking quickly. Okay, but you got to go through a process first. First, in order to do this, you have to dispute with the credit bureaus first. That's the law. Second, go to the creditor next. Certified mail, so you have written receipt that they received the actual dispute. With that in hand, and if they don't respond within 30 days' time, File a complaint with the BBB. File a complaint with the CFPB. And you'll see that account get removed really quickly because they're violating the law if they can't verify an account that's actually being reviewed. Else is okay with it. Okay, so length of credit history, 15% of your total score. Okay, thanks for the process. Yeah, that maps it out for you. The next aspect of your score is new credit. It has to do with inquiries, 10% of your score. The number of accounts you've applied for. The number of accounts that were actually open. The time passed since the opened and applied for accounts. All auto and mortgage inquiries within 30 days count as one. So let's look at this again. First of all, people think that when they have inquiries on their credit report, it drops their score. It's not true. Groupings of inquiries drop your score. If you have your credit inquiry put on your report today, it probably won't lower your score. If you put 7 inquiries on your credit report today, it will lower your score. It's not credit inquiries, it's groupings of inquiries that affect this aspect of your score. It's the number you applied for. It's the number of those that were open. It's the time passed. So if you apply for a bunch, your score goes down, okay? If a bunch of time has passed since you inquired, your scores won't be impacted as much as if you applied for a bunch today, okay? And if you apply for a mortgage and they send it to 12 lenders, or you apply for an auto loan and they send it to 15 lenders, and you see a bunch of inquiries, don't worry. All auto and mortgage inquiries only count as one into your actual FICO score calculation. Okay, so that's what you need to know. Next aspect of FICO score, credit mix, 10% of your score. Has to do with having the right mix of accounts. You want to have 3 credit cards or more. You want to have 1 to 2 car and auto, that's wrong, mortgage and auto loans. You want to have 1 to 2 physical loans outside of mortgage and auto. Thanks for the loves, thanks for the shares, and thanks for the kisses. Love, kiss, love, kiss, love. That's awesome. So you want to have 3+ credit cards. You want to have 1 to 2 auto loans. You want to have 1 to 2 mortgages and 1 to 2 regular loans to have the most important credit mix. So let's look at this again. Payment history. Pay your bill as agreed. Okay, and if you don't pay your bills agreed and have negative, well then get more of them. Get more positive accounts to offset the negative accounts. Get as many positive accounts as you can, but keep in mind that applying for a bunch of new credit in a short period of time will lower your score. Keep your utilization low. The percentage of limits you have on your credit card, the balances compared to limits, should be as low as possible, preferably below 2%. And old accounts, are they negative? No. If their report is positive, they're not. You want to keep them on there because the length of credit history, the time you've had credit. They're going to look at the average oldest account, and the average apply for will radically lower your score if you apply for too much in too much time. How much is too much time? Try to every 6 months has the biggest impact on your credit score. 2 years, I think, overall affects your credit score. And try to have a good credit mix. 3 credit cards or more, 1 to 2 car loans, 1 to 2 auto loans. That's the way to have the best FICO score. But don't worry, we're not being done yet. I got a bunch more stuff I want to go over because we're only talking about FICO. We haven't talked about the credit bureau's Vantage score yet, and we haven't talked about what a credit score means. We haven't talked about credit scorecards, so a lot more to go. But now, you know how FICO works, which I love because I'm a math guy. I love math. My son loves math. It's just a family thing, I think. My dad's an accountant. I guess it's just genetic. So here's what I love about FICO. It's math. And now that you understand the math, you understand how to improve every aspect of the score. You improve each aspect of the score, your total scores will shoot out through the roof. Okay, so now that you understand the math, let's dive a little scorecards. So if you've ever wondered why, for example, you pull your credit online and it's one score and an auto dealer pulls another one, somebody says 6 credit cards, is that too many on file? No, not necessarily. Not as long as you're not applying for them in a short period of time. So every industry has what's called a different scorecard. Okay, and these scorecards are used to better judge the applicants for those industries. So let's look at two of the most popular. An auto industry options scorecard, a mortgage industry options scorecard. I'm about to teach you something that most finance managers at auto dealerships and most mortgage brokers don't even know. They pull your credit and they don't even know that they're pulling a specific scorecard called a mortgage or industry auto option. So it's like this. If you apply for a car loan, what type of account do they care most about that you've paid as agreed in the past? I'm not going to even answer the question. I'm going to let you answer the question. If you're applying for a car loan, then on your credit report, what type of account in the past do they care about that you paid as agreed or didn't pay as agreed the absolute most? Hopefully you guys don't leave me hanging. Hopefully somebody throws out a comment and answer to what I'm saying here. Or I'll ask another question. If you apply for a mortgage, then what type of account do they care about that you paid as agreed in the past? Okay, it's a car loan. Exactly. Somebody just came in here. Was it DJ? Just came in with the answer. So if you're applying for a car loan, what they care about most is how you've paid your past car loans. So because of that, they score your past auto history heavier into your overall score than anything else. This is why if you go in the same day and you pull your credit monitoring credit score, then you go in and apply for a car loan, then you apply for a home loan, all three of those scores would be different. It's because they are pulling their own scorecard. They are pulling a mortgage scorecard. They are pulling an auto scorecard. The mortgage scorecard looks at your past mortgage history and scores you differently based on how you paid. So let's say you have really good past mortgage history. Well, then your mortgage credit score could be even higher than what you're going to see on credit monitoring. But let's say you have bad payment history in the past on a mortgage. Well, then your mortgage score could be even lower than what you see on credit monitoring, because these scorecards look at the type of account that's most important to the lender or credit issuer. There's about 16 plus of these scorecards, one for every industry. It's one of the reasons. There's another credit score out there other than FICO called Vantage Score. Now, Vantage Score, I just showed you how FICO works. Vantage Score is the credit bureau's own credit score, and it's a little different. Okay, and somebody's asking, what if you don't have a mortgage? What would they look for? Well, they're not looking for anything. They're going to score mortgage history heavier than anything else in your score. So with no mortgage history, then your score would be lower than what you would normally see on the consumer side typically, because you don't have any good history there or bad. So it's not going to be higher. It's typically going to be lower if you have none. Okay, because remember, you also want to build your credit mix because it helps that aspect of your score. So Vantage Score, 32% of your score's payment history, 23% utilization, 15% balances, 13% the depth of credit, 10% the recents of credit, 7% available credit. You don't need to know this crap. What you need to know is that this is obviously different than this. The Vantage and FICO are two completely different scoring models. Vantage is owned by the credit bureaus and it's offered through their owned credit monitoring services. You could probably Google credit monitoring services the credit bureaus own and find out which ones you may see Vantage. Okay, this is a problem because older Vantage scores actually have much different score ratings than FICO. So let me show you what I'm talking about. Here's how FICO score breaks down. You have an excellent score per FICO if your score 750 plus, good credit if you're 700 to 749, fair credit if you're 650 to 699, and FICO says your credit's poor if you're 600 to 649 or bad if you're 599 or lower. Vantage says you are excellent if you're 900 to 990. You are good if you are 800 to 899. You are fair if you're 700 to 799. You are poor if you're 600 to 699. And you are bad if you are 501 to 599. Vantage score only goes down to 500 to 990, whereas FICO goes from 350 to 850. So very big. Now, the newer Vantage scores, they modified this. They realized this didn't work, so they went more of a FICO model where it's an 850 score. But I'm showing you this because you could see some crazy high score and not realize it's Vantage score. And you need to know that because lenders, credit issuers, all of them, some of them do use Vantage, and some credit monitoring services also use Vantage scores as well. So, a lot of stuff. But you have a pretty good of how your consumer credit score works, and I guarantee that you know something now that you didn't know coming in, because I'm teaching you stuff industry professionals don't even know. So a lot of lessons to be learned here. First of all, you have a lot of false information. That's great. What part of this information is false? Please tell us. We would love for you to openly share and tell us. So go ahead and type in details while we're talking a little bit more. So now you've learned a lot of things. First of all, you have 3 types of credit that you have. You have business credit, you have consumer credit. Consumer credit's linked to your social, business credit's linked to your EIN. And why do people worry so much about credit scores? Because credit scores are used to determine if you can get a home loan, if you can get a car loan, if you can get credit cards, what you can get in regards to regular loans, business loans, the rates you'll pay, the terms you'll pay, the insurance premiums your scores, your insurance premiums you'll pay. Credit scores are used to depict a lot of things. And bottom line is your quality of life is ultimately determined based on your credit quality in a lot of cases, because having good credit means you get better terms. Having bad credit means that you get worse. I've never paid attention to mine and never had trouble. Fantastic. Congratulations. And a lot of people are not exactly the same way. If you haven't paid attention to it, then great. It works for you. But a lot of people are. A lot of people care about the rate that they're going to pay on a mortgage. A lot of people care about the rate they're going to pay on a car loan. And I can tell you, owning a mortgage company, it's really simple that the rates you pay are 100% determined based on your credit score. So let's say you have 2 people, one like you that doesn't care about your credit score, and somebody that does and actually takes steps to get a higher credit score. When you guys both apply for loans, you literally will end up spending easily $50,000 to $100,000 more in the lifetime of the loan. Maybe you don't care. Maybe you got $100,000 liquid in the bank on a month-to-month basis. Maybe that doesn't matter to you. But a lot of people would like to have an extra $100,000 towards their savings or retirement, and it makes that much of a difference. The difference between 1/4 or 0.5% rate on a mortgage means a lot of money saved. So by knowing what your credit scores are and how they work and actually focus on getting yourself the best score, then it makes a lot of sense, because the money you're going to pay in interest on credit cards, auto loans, and mortgages through your lifetime will be substantially higher than somebody that has good credit, that does care, and that focuses on building a healthy credit profile and score. It's just math. Like I said, I'm a math guy. That's why I like credit scoring. So a lot of things we learned today. 3 types of credit. You have bank credit if you're a business owner. That's how banks rank you for business loans. You have business credit that's linked to your business EIN number. You have consumer credit that's linked to your consumer social security number. Remember, there's 2 main scores out there you're going to be exposed to. The FICO score, which really has to do with about 35% of your score being payment history, 30% utilization, 15% linked to credit history, 10% new credit, and credit mix accounting for 10%. Then you've got Vantage score, which is kind of similar. Both of them, it comes down to the same thing. The 2 most important factors are payment history and utilization. Tips as we wrap up, that if you're going to go late, make sure that the most recent late payments hurt you the most. Going frequently late or going really late on accounts really hurts. So if you're going to go late, call your creditors. Sometimes, in a lot of cases, they will work with you and let you go late without reporting, but it only happens if you're preventative. Utilization, keep the limits or the balances on your credit cards as low as possible. Consider calling your creditors if they don't and regularly raising your limits. That'll help your utilization, which is about 1/3 of your total score. Link to credit history, not much you can do here because it has to do with how old your account is and the average age of all your accounts. You can get added as an authorized user to a family or friend's account. That could actually help you with link of credit history. The amount of new credit you're applying for, don't apply for too much. Remember, the number of accounts you apply for will lower this score, but also remember, auto and mortgage score inquiries in 30 days all count as 1. So all you need to know is don't apply for too much new credit too soon. And make sure you have a good credit mix. Work on getting 3 credit cards or more. Make sure you have 1 to 2 auto loans, 1 to 2 home loans, 1 to 2 regular loans. That's really going to help you maximize your overall score. Where do you rank? Well, here you are. Depending on where your score is per FICO, Here's how they look at it. Excellent 750 plus, good 700 to 749, fair 650 to 699, poor 600 to 649, bad is 599 or lower. And don't forget about Vantage Score. You might see scores out there, even though they've changed this model, that are much higher than what you normally see with FICO. That's a clear indicator that you're looking at the credit bureau's Vantage Score, not popular with lenders and credit issuers. You really want to make sure that you're looking into a FICO score. So before you sign up for credit monitoring service, you might want to Google to see if it's FICO or Vantage you're looking at, and you probably only want to stick with one that's a FICO score, because that's going to be closer to what lenders and credit issuers actually are using. So that's going to wrap up today. We really decoded consumer credit and talked about everything you need to know about consumer credit. We even talked about scorecards. So this is why you have so many different scores out there. Each bureau has their own FICO score. You should know this. So if you want to know why your scores are different between the bureaus, it's probably because you have different accounts reporting to the bureaus. So if you look at what's on Experian, you probably have accounts that are there that are not on Equifax and TransUnion, and you probably have accounts on Equifax and TransUnion that are not on Experian. That's why the scores are different. Each reporting agency has their own score that they get from FICO. So, and your score only takes into account information that's on your consumer credit report. Thanks for the love, guys. Thanks for the shares. Thanks for the comments and engagement. I appreciate it all. So, that's what you need to know, is that, each bureau has their own score, the different information reports on each report. So because of that, that's why you're going to have different scores. And we talked about a bunch of tips to maximize your credit score. But remember, if you have derogatory items on your credit report, you don't have to deal with that. If you want, you can email us, info@creditsuite.com. We do not do credit repair, but I strongly believe in credit repair because it works, and will get you with a reputable company that can help you. Remember, even if you don't work with a professional company, the Fair Credit Reporting Act says you have the right to challenge anything on your credit report. It says that everything on your credit report must be 100% accurate, 100% verifiable, and 100% timely or within the statute of limitations. It's allowed to be on your credit report. You can indefinitely challenge as much requirements, and the law says if not, you need to get it removed. Paul is here. He says he does credit repair, and Paul comes on our scopes all the time. So get with Paul. Paul can actually help you with credit repair. If you want, you guys can exchange information right now on this scope. Paul, why don't you go ahead and type in your information here too, because people that are watching this on playback, which we record these even and make it available for all of our customers on playback, they're probably going to want to know how to get in touch with you. So D818consulting.com. Paul does credit repair and is on these scopes all the time and talks about credit, so Paul knows the ins and outs of this. Aren't EIN connected to social? Nope, not even close. An EIN is a number that identifies a business in the United States, and a social is used for an individual in the United States. So two completely separate numbers used for two completely separate purposes. Both have their own credit profile and score, and if you truly want to separate your personal and business liability, you need to focus on building your business credit as well as your consumer credit. And if you're not clear on how EIN business credit works, then go to creditsuite.com/scope. Look at our previous Periscopes where we map out exactly how to build business credit that's linked to your EIN, not your social. So we talked about a lot of stuff with consumer credit. In the future scopes, we're going to be talking about bank credit, the secret credit score that banks have to use to score your business for business loans. We're also going to talk about business credit. We're going to decode D&B's credit scores, FICO SBSS score. We're going to look at Experian and Equifax Commercial's business credit scores. We're going to decode all this. We'll even compare some of this to consumer credit. If you missed the first part of this scope, then this will replay on Periscope, and we put it live in about 48 hours on creditsuite.com/scope as well. In Dallas. Okay, so you should connect with AM Credit Consultant in Dallas. They are awesome sauce. Okay, so that's another great company and recommendation here. I'm not familiar with them. I am familiar with Paul. Paul's a stand-up guy, so they could be awesome too. I appreciate the recommendation. Okay, great. Can you share net 30 term accounts? Yeah, there's a lot of net 30 accounts. Uline, Quill, Seton, Gimplers, Monopolize Your Marketplace. AMB Credit is the name of the credit company that you're recommended, and I appreciate that. Gimpler's, Uline, Quill, Seaton, Monopolize Your Marketplace. Those are a bunch of starter vendors. If you go to creditsuite.com or youtube.com/credit suite, we share a ton of videos that go through other type of vendor accounts that can work for you there as well. So remember, you have the right to challenge anything on your credit report to make sure it's 100% accurate, verifiable, and timely. Use a responsible credit repair company to do it, or do it yourself. I don't care. But never sit with challenge credit. It's insane to do so. Because in my experience, if you're challenging the credit bureaus and your creditors for derogatory items, you're probably going to see 80 to 90% or more deleted. And that's what we saw on average, just because most of the crap is not reporting accurately as it should. And a lot of people say, hey, look, I went late on that account. Great. Okay, so be it. So you still need to challenge it, because maybe you didn't go late the month they told you. Maybe the balance that they're saying is wrong. Maybe the high credit is wrong. You have the ability to challenge every aspect of that account. And what a lot of creditors do is they manipulate little things on your credit report that you wouldn't notice with the naked eye. And those little things really radically adversely affect your credit score. This is why credit repair is so effective. It's because so many creditors misreport information. And you know what's interesting? Owning a consumer credit company, having looked at over 10,000 credit reports in my professional experience, I have not once, ever seen a derogatory item on a credit report that helped somebody. I've never seen something be wrong in a way that it helped somebody. Although I've seen 100,000 plus derogatories that all hurt somebody. So it's interesting, isn't it? How the only thing that creditors ever get wrong on their credit report always hurts you, and yet there's nothing ever that goes wrong where they misreport it where it actually helps you. I don't know if it's intentional or not. It just seems a little odd. But I will tell you this much. You have the right to challenge it per the Fair Credit Reporting Act. Please do so, because credit matters so much to your life, and you have the ability to control it. You now have a lot of tips. You now know how to challenge it. We talked about a couple credit repair companies that can help you along the way as well. Make sure you look into it. If you need any help or have any other questions, reach out to us. info@creditsuite.com. Look forward to talking to you on our next live scopes every Wednesday here at 4 o'clock, where the next couple weeks we're going to talk about bank credit and business credit as well. Thank you very much for coming. It's awesome that you're here. Thanks for the hearts and loves. Thanks for the shares. I really appreciate it. It really means a lot. Thanks, everybody. Have a great day. I will see you next Wednesday at 4 o'clock. And yes, I will see you tomorrow, Paul, because I'll see you on our Facebook Live at 11 o'clock, where we're going to be talking about a completely different topic. I'm not sure whether it's bank credit or business credit, but one of those two we'll be diving into tomorrow on Facebook Live. If you want to get a head start, go to our Facebook page, facebook.com/credit suite, and check out our Facebook Live. It'll happen tomorrow at Thursday at 11 o'clock Eastern. Bye, everybody. Thanks for showing up. I appreciate you sticking with me. Appreciate the engagement, the loves, the shares. It means a lot. Thanks, everybody. Have a great day. Have a great week. See you, everybody.